started as a chip designer out of Stanford before joining Medtronic, where I developed implanted medical devices. My dad's pacemaker is the first product that I developed while I was at Medtronic, and it's still functioning for at least the next couple of months when we have to change it out because his battery's actually well overdue to be changed. While I was at Medtronic, I went to business school, and then I joined Philips Semiconductor, where I built the broadband division. I was the country president in Singapore for that project. Unfortunately, the dot-com bubble ruined all the fun that I was having in Singapore. At that point, Philips was sold to NXP, and I took that opportunity to go to law school. After law school, I came back to the Silicon Valley to practice at Fenwick and West. I consummated 28 acquisitions for Cisco Systems during that time, and I also defended Hewlett-Packard and Apple against patent trolls. From Fenwick, I joined Applied Materials. I was employee number 1, brought in to build the direct materials division and formalize the alliance management office. From there, I joined SK Telecom to build and run a core technology accelerator. So we were very focused at that time on what today is being called deep tech, so things that are highly technically differentiated and IP defensible. And we were investing about $1 million per check in each one of our portfolio companies, and we also gave them executive services to help them raise their next round and go to market. I had a pretty good run at SK Telecom. Based on my investment track record, it looked pretty appealing to some LPs, so I stepped out, started my own VC firm. We raised about $50 million of a $150 million target, and then unfortunately the politics in the country were replicated inside the partnership, and we went in very different directions. From then until now, I've been running I2I, or Idea to IPO, and we offer corporate strategy services primarily focused on fundraising and exit preparation. As Miguel said, to start, this session is intended to be interactive. I do have quite a few slides, but each topic on our agenda, or each item on our agenda, could easily be a full presentation. So my goal with this is to just kind of take you through the topics, and hopefully we can pause on the ones where we have the most interest and we can drill down on those. But again, I have about 20 minutes worth of actual content prepared, and it's usually just, it's intended to just be a conversation starter. Please, feel free to send your questions in via chat or just interrupt me at any point. So the two things we're going to talk about today is fundraising and exits. So in fundraising, we'll talk about the note rounds, equity rounds, and public offerings. On exits, we'll go through the strategic acquisitions, private equity acquisitions, and then IPO, and then a very specific type of acquisition, which would be the SPAC. The exit is, well, all of this is actually from the entrepreneur's perspective. I'm not talking from the investor perspective during today's presentation. To get started, let's just set some definitions here, because in this, there's a lot of acronyms that get thrown around in this ecosystem, and very few people actually have precise definitions for it. So when I talk about pre-seed, I'm just really talking about companies that are pre-revenue. Seed companies are below $5 million in revenue, and equity is above 5 million. The 5 million is not arbitrary. Today, the average Series A is about $16 million, and the hurdle rate that most VCs use to consider companies for that Series A is $5 million of ARR. If you're below $5 million of ARR, you're typically going to have to go raise that money through angels and high net worth individuals, family offices, micro VCs, everybody but the VCs. Once you achieve $5 million of ARR, then the VCs become a viable path for you. The fundraising strategies really differ between the note rounds and the equity rounds. When we're talking about note rounds, it's really a numbers game, right? It's how many people can you get your deck in front of in as short a period of time so you can generate that legitimate fear of missing out. With Series A and above, so your equity rounds, these need to be very laser focused. This is where you exercise your network to make the connection to the investor that you want on your cap table. So let's get started with just a little bit of market analysis here. What we can see on this chart is the deal count, even going back before 2016, has been steadily increasing year over year, with a sudden pop in 2021. And oddly enough, 2022 was even better in terms of the number of deals that got done during COVID. So this chart to me was very illuminating, especially last year when there was a lot of concern that there was not going to be a lot of investment dollars going into these early stage deals because people were pulling back as the economy was recovering from the COVID dip. The other thing you can notice here is the deal value has also been pretty steadily increasing over time, with the one notable exception in 2021. But even the regression toward the mean that we see in 22 is right in line with about where the deal values had been tracking prior. If we contrast that with the later stage deal activity, it's significantly more lumpy. As you can see here, we had a really good year in 2018, a phenomenal year in 2021, but then a significant drop off to 2022. But conversely, the deal values, or the amount of money going into later stage deals, has stayed relatively constant across this time, right? So we're still seeing a steady increase over time. The median valuation, right? So this is total dollars that are being put into late stage deals, is the line. But if you look down here, there was a drop off in the median valuation of 17% in 22. And I've actually seen that significantly worse just in the last couple of months here in 23 for the later stage deals. You contrast that with the early stage deals, there was an increase from, I guess, $2.3 to $2.7 million on average. So that was kind of interesting for me to see. But the only thing that explains this is there still remains a lot of dry powder in the earlier stages. The later stages, we are seeing some pullback. We are seeing some LPs not funding the VC funds at quite the level that they were prior. I've had plenty of clients that were pre-seed, pre-revenue companies that were able to get first funding completely external. Usually what they had to have was they had to already have the MVP done. It's gotten incredibly hard to get investors, especially on the software side, to fund development now. There's so much open source. There's so many building blocks out there that they just don't see. And personally, I agree. There's just no reason to fund a development on a software program from the ground up. The founders themselves can just take a couple of months, go code it up, show me an MVP, show me some wireframes, show me that you can actually code what you said you can. The key to that is, one, you have to have a very compelling value proposition, and you need to demonstrate product market fit somehow, right? Yeah. So the key to getting a pre-revenue company get funded is the compelling value proposition and some strong evidence of product market fit. So product market fit to me is just code for revenue, right? But for the early stage companies, you actually do need to create something that evidences product market fit short of revenue. So those can be LOIs. You can have a certain number of freemium users that are on the platform. You just need to show that if this thing gets funded, if it's going to be successful, assuming everything you say is true and it's going to be successful, there is a market for it. If you can prove that to investors, I have found several of our clients getting funded without having to put in their own funds or having wealthy friends and family around them that are willing to help fund their concept. I've got a great case in point. I had a client come to us, and they had developed a new technology that through RF, non-invasive RF waves, can treat people, like a whole room full of people at the same time. And they had some really good anecdotal data of some private quasi-clinical trials that they'd run in Africa, where they were treating up to 25 people and being able to show that they could cure AIDS in these people with 6 treatments of 1 hour apiece. We took that out, and they needed about $70 million to get through all the clinicals to make this a real product, but we were trying to raise $2 million just to continue the development of the product and keep the team involved. We were completely that was just a complete and utter failure. We just didn't get enough angel investors interested. So then we shifted focus and we decided, well, what if we just tried to raise the full $70 million? And oddly enough, we actually found a taker. So that company found one investor that funded the entire thing. The health tech, pharma tech, bio, that whole world that has those clinical trials in there is a world unto itself. And the normal rules of most of the stuff that I'm going to be talking to everybody about today is for the traditional tech-based startups, right? The typical Silicon Valley startup. But if you're in that bio or pharma, health tech category, those market dynamics are completely different. And part of the reason they're so different is because of those clinical trials that kind of interrupt the commercialization flow that most normal products go through. When you're raising money from non-VCs, right? The note rounds, convertible notes, safes. I just saw another one called a cafe. I haven't looked at the nuanced difference between a safe and a cafe, but they're all basically of the same flavor. The idea is it's almost impossible to value one of these companies at this stage. So really what investors are doing is they're lending money to the company. It's a loan with the expectation that the loan is not going to get paid back. It's going to convert into equity as soon as a valuation is available. The technical term for that is the next qualified financing, and the next qualified financing will be defined in the documents. But fundamentally, what it's going to say is when we have a Series A that's greater than $5 million, then your equity will convert at some sort of a discount. So if I invest $100 today, when I go reclaim my whenever I have my conversion, I'm going to get $120 worth of shares. So you just get the discount that you receive is kind of the risk premium from coming in this early in a company's life cycle. At this stage, as I mentioned earlier, it's a numbers game, right? It's volume. It's not a laser focus the way you do the equity rounds. The industry statistics show that for every $100,000 in capital you want to raise, you need to make contact with at least 100 investors. So the methodology that we've developed at I2I is we use a three-pronged methodology. We use an AI that creates a 2,000-point psychographic profile of your ideal investor. Then we use that profile to find matching profiles on LinkedIn. The challenging thing about that is that angel investors rarely self-identify on LinkedIn, probably for self-preservation reasons. But then what the AI does is it'll go out and check slime trails, right? So it'll look for postings these people have had on LinkedIn, Facebook, Instagram, Twitter, whatever social media platform they look, or whatever platform they use. What it's looking for is confirmation that this person isn't just an investor, but they invest in your space. From that point forward, it's very much just a traditional drip campaign. I'm sure you guys are all inundated with people raising money in your LinkedIn boxes. I'm one of those people. That we also have a proprietary database of about 1,800 angel groups and micro VCs that only accept online applications. Of those 1,800, we'll usually find somewhere between 400 and 600 angel groups and micro VCs that our clients qualify for, and we'll submit all of the applications on their behalf. And then finally, we use the same AI to search an investor database. And the reason we use the AI is because it helps us rank order the people that we're reaching out to from the most likely to invest first to least. And then we'll just keep the campaign running on both LinkedIn and email until we raise the amount of capital that we need. So if we put all three of these things together, right? If for every $100,000 of capital you want to raise, you need to reach out to 100 investors. And the $2 million convertible note is the one that closes the fastest right now. Using our methodology, we can get to the 2,000 investors that you need within the first 2 months of operation. And from that point forward, we just keep it going as long as we need to raise the capital that you're going to require. And just a couple of things that I've heard in the last few weeks that kind of resonated with me. I get a lot of clients that come to me and say, hey, I only need 500K. Can you help me raise 500K? And yes, using the methodology that I just described, we can help you raise 500K, but it's not going to be any easier than raising 2 million, right? The reason the $2 million raise is closing the fastest right now is because that's what investors want to see. So unless you've got a really good reason for not raising $2 million, raise $2 million. But regardless of whether you're raising 500K or you're raising 50 million, right? And I'm currently, well, I'm not doing any 500K raises, but I'm doing some small raises and I'm doing some really large raises at the moment. And I can tell you that the time frame for all of those is about the same. And that holds kind of across industries as well. If you want to raise, you should plan on taking at least 6 months to raise your round. When you're budgeting how you're going to raise your round, a really safe number to use for your internal planning purposes is 6 months. It takes about 6 months, whether you're going to raise 500K or 50 million. So don't set your expectations of how much money you need based on how much money you're going to raise. Because the smaller the raise is, the check sizes get smaller, but you still have to reach out to as many, if not more, investors to get those smaller checks. The larger checks, because they're coming from institutionals, they can write bigger checks, but their diligence process is going to be a little bit longer. So net, you're going to be at about 6 months anyway. So instead of trying to figure out, should I only raise 500K because it's a smaller number, it's not going to be an easier to raise. So figure out how much money you should raise and then go raise that, as opposed to trying to game the system, right? And say, oh, it's only 500K. I'm sure I'll get some investors for that. Which leads me to the next thing, right? Which is not raising enough versus raising too much money. How much money should I raise? Well, there's two ways that you should look at this. One is the bottoms up. How much money do I need to raise to reach the milestones that I'm messaging to my investors before I have to go raise more money? That's the first thing you should do. The second thing you should do is pay attention to the market. Again, if the market is telling you that the $2 million round closes the fastest right now, then maybe you set your spend plan and your milestones even with that $2 million, right? Fundraising is hard. So take as many shortcuts as you possibly can. If the market's telling you $2 million is the fastest way to raise money, raise that unless you really need to deviate from that. If $2 million doesn't get you where you want to go, then don't raise it, right? I have a manufacturing client right now who needs to build a factory. We either need to raise $7 million or we go home, right? There's no in between. We're not going to be able to outsource it. We either have to build what we need to build or we're not going to be able to do it. We know it's going to take longer, right? A $7 million seed raise from angels, that 6 months is not enough time. And as long as you're prepared for that, and you know that going in, you can set your expectations appropriately. Some other things to keep in mind is that, as I mentioned earlier, the average Series A today is $16 million. For companies that are raising those rounds today, most of them have already raised approximately $6 million in note rounds. They've usually done 3 separate note rounds. And the way those look is a pre-seed round, a seed round, and a seed 2 round before they get to Series A. And that is probably 80% of the companies that are raising Series A today follow that sort of pattern. We've run Kickstarter campaigns, Indiegogo campaigns to raise money. Kickstarter, I tend to prefer more as a marketing tool than an actual fundraising tool. For my hardware clients, we frequently will run a Kickstarter campaign because they need the funds to build the first products, right? And Kickstarter kind of gives you the best avenue to be able to do that. The crowdsourcing campaigns, I think they work well for the consumer markets. Based on my background, the majority of my clients, and I don't advertise, all of my clients have come through my referral network, or through my network, I should say. And because my network is very hardware based, a lot of my clients tend to be very hardware based. But when I do have clients that are targeting the consumer markets, and in fact, right now I'm working with an IoT client that is targeting the consumer markets, and we have run 2 very successful Kickstarter campaigns for him, one here in the United States and one in Japan. But I think they serve their purpose. You need to be a little bit careful because it can also be very expensive. So yeah, as long as you kind of mind what you're doing, make sure that the type of product that you're putting on that platform is appropriate for the platform. I've had good success with those channels as well. Before you get to that $5 million of ARR, if you're a software company, getting the attention of the VCs really hard. So, and getting a valuation is pretty challenging as well. So the $6 million that they raise before they get to the Series A is usually your first equity round. So we're talking 3 successive convertible note rounds, whether they're the traditional convertible note, the SAFE, or this new CAFE that is starting to get popular. Fundraising on the equity rounds. This is, I guess, very tried and true, right? This is what everybody does. It's what I do. It's what the investment banks do. Fundamentally, you pick 5 to 7 VCs that fit your startup profile. You need to make before you reach out to them, make sure that they don't have any published portfolio companies that are competitive with you. If they do, it's highly unlikely they're going to invest in the same category again. And if they already have a portfolio company in their stable, the last thing you want to do is go share your competitive information with them, because that information technically is not supposed to leak over to their portfolio company. But why take the risk, right? So just double check that they don't have any published conflicts in their portfolio. But more important than that is make sure before you reach out to, or in your discussions with the VCs, that they have an active fund and that they're deploying capital. There's 2 aspects to this, right? One is whether they're actually deploying capital. A VC fund is a 10-year fund, and they need to deploy all of the majority of their capital within the first 2 years of the fund life, because it takes 5 to 7 years for most of those companies to mature to an exit route, and you want to give yourself a little bit of grace at the tail end. So what you want to make sure is that you are in that 1 to 2 year time frame at the beginning of the fund cycle. Most of these funds, if they have an exit, like let's say they get lucky and they have a really great exit in year 3, most of that money is going to get sent back to their investors, their limited partners, or LPs. Some funds, however, have the capacity to reinvest those funds into other startups. But let's say you do that in year 5, you come in year 5, that might not be where you want to take that money, because you're only going to have 5 years before that VC starts pushing you really hard to exit, right? Because at that 10-year mark, they have to pay their LPs back. And they're not very happy if their money is still tied up in an illiquid startup. So be kind of cautious of that. Beyond those things, it's, find the 5 to 7 that you want on your cap table, and then exercise your network to get introductions to them. So that's very straightforward. Now, some things that I kind of hear percolating in the background here are self-priced rounds and pre-revenue VC rounds, right? So self-priced rounds, that's where the company decides that they're going to price themselves and then go out and sell stock. Don't do that. You're just going to waste your time. I can't tell you how many clients I've tried to talk out of doing that, and then they decide they really want to go fundraise with a priced round that they're going to self-price. I've never had good luck with that sort of structure. Investors really want to see like a professional investor come in and give you a valuation that they can support, as opposed to the company kind of trying to come up with its own valuation. The other thing is pre-revenue VC rounds are almost unheard of today. There are some micro VCs that will come down into the note rounds. There's quite a few that behave very similar to angel groups in that category. But for the most part, if you're pre-revenue, your time is better spent looking for funding from high net worth individuals, right? Angels, family offices, and micro VCs. Let's talk about acquisitions. So just a little bit of technicality here, but we all, and myself included, tend to refer to acquisitions as M&A. Realistically, mergers, I can't remember the last time I saw a legitimate merger. Most of the time when we're talking about M&A, we're specifically talking about just the acquisition. The acquisitions come in different flavors. These are probably 4 of the most popular. There's a strategic acquisition where you get acquired by a competitor, customer, or supplier. Institutional acquisitions, these are private equity firms or other investment groups, like family offices will sometimes fall into this category. There's IPOs. I'm not sure whether I would classify an IPO as an exit. It's an exit for the investors for sure, but an IPO could just be another way of raising funds for the founding team or for the management team. So I would say IPOs kind of fall into both a fundraising category as well as an exit category, but they're so different from most of my fundraising work that we tend to break them out into the exit category a little bit more. And then there's very specific types of acquisitions that became very popular, have subsequently dried up a little bit, but they seem to be experiencing a little bit of a renaissance, and those are SPACs. These are public shell companies. There's no operations. It's basically just a group of industry experts that take a blank check company public, and then they raise money from the public markets, for example, on NASDAQ. Once they raise a certain amount of money that they've disclosed to the SEC that they want to raise, they will then go buy a or a private company the day after that merger or that acquisition closes. And actually, that is it's a true merger. The day after the merger closes, then the company is suddenly a publicly traded company. So you have to be a little bit careful with the timing. And the other thing about SPACs is they only have 1 year in which to consummate one of these transactions in the main. So they have a limited time frame. So when you reach out to SPACs, you need to be cognizant of when their IBC, when they have to close before the SEC revokes basically their ability to remain as a SPAC. So just a little bit on some of the market data that we've seen lately. As you can tell here, so this chart unfortunately is exactly backwards, right? So the deal value is actually the blue here and the deal count is in the white. So as you've seen in the last few years, we've seen a lot more acquisition activity taking place by a lot. 2021 was kind of a banner year. 22 was good. I mean, even by historical standards, it was a really good year. This year, from a deal count perspective, appears to be even better, but the deal value has also been increasing over the last few years. The one gotcha is the excuse me, the large deals, the billion-dollar deals, have been on a steady decline since 2007. Right? There's a huge drop-off early on up to 2013, then we saw a resurgence, but since 2015 it's been a pretty steady decline. Part of this is regulatory. It's getting harder and harder to get massive mergers through the SEC. In fact, some of the regulatory stuff I've seen lately is starting to impact even the private raising. So I'm happy to get into the regulatory stuff at another point, but I just saw that one thing that I've been hearing from a lot of my clients is the market shifting, right? Do I have to sell my company or should I go fundraise? Is there still money available for fundraising? The statistics that I've been reading and the anecdotal data that I have from the campaigns that my company is currently running is that yes, there is investment dollars available, but there's also a very active and thriving acquisition market right now. So I think as an entrepreneur of a mid-stage company, you have a lot of options with regard to whether you want to raise money, get acquired, or perhaps IPO, and I'll talk about that a little bit later. If anybody wants the deck, just please send me an email or connect with me on LinkedIn. I'll send you the deck. Fundamentally, I just wanted to kind of lay out, the four different, the majority of the acquirers that you could potentially consider. One is family offices. The interesting thing about family offices is that dividend returns are acceptable, right? So a lot of times they'll buy a company for the cash flow, and they will take, they don't need to have necessarily control of the company. The other thing is with strategics, one of the things that I like is one, their valuations are much higher, but two, the story matters to strategics. And I'll get into that a little bit later when I go into them specifically. Institutional investors, these would be like private equity groups, and private equity groups fall into two categories. There's the invest and grow, which operate very similar to VCs. They're still looking for that 40x return in 5 to 7 years, right? So very similar to the VC model, but the majority of them are this purchase and flip sort of caliber of PE, where they just want to buy the team or buy the company, replace the management team, and usually slim it down, resell it, polish it up and resell it. The other category would be the IPO and SPAC. The advantage to the founding team or the management team during an IPO is that ordinarily right after you IPO, you get a little bit of a pop to your stock. That's a great opportunity for you have to pre-declare how much money you want to sell into the IPO, but that's a good time for some of the management team to get out a little bit of money. And then obviously there's the SPAC companies that can help you IPO, and that is a little bit of an exit, also a fundraising strategy that we can get into a little bit more. The timeframes tend to vary quite a bit as well. For most of these, you're looking at about 6 months, right? Again, that 6-month mark, the diligence that it takes after you make contact with an investor or an acquirer, it's going to take about 6 months before they can consummate the deal. The one exception to that would be the IPO or SPAC, and that's because there's a lot of prep work that has to go into being able to take your company public. So again, exiting to family offices, right? One of the interesting things about family offices is that they will consider companies that are struggling to scale and raise capital, right? And a lot of times they will come in and take a controlling interest in it, and oftentimes they have the management expertise to help the company kind of work its way out of that. Earnouts are very common, right? Family offices usually are not staffed to take over a company. They don't have a management team just sitting there waiting to take over one of their companies. So they're almost always going to ask the management team to stick around. They're deploying their own capital, right? So they can be as flexible and creative as they want in putting together the acquisition package for you. Unfortunately, the time frame and process with family offices varies widely, right? Some of them are very organized. Some of them come from an iBank or a VC background, and they're going to look and feel just like one of those entities. They're going to be quick in doing their diligence. They ask the right questions, and they're just going to try and push the process as quickly as possible. Others are wealthy individuals, obviously, but they don't have a lot of investment expertise, and you can end up answering a lot of questions that are completely extraneous to the acquisition. And unfortunately, it's really hard to tease that out before you actually start the dialogue with the family offices. Now, strategics, the thing that I like about strategics, as I mentioned earlier, is your valuation is going to be higher. They're less cost conscious because they're making a strategic acquisition, right? And the story with strategic acquirers really matters, right? If you're going to 3x the company in the next 4 or 5 years, and the reason you're trying to get acquired is because you need the power or the purse strings that the acquirer brings to be able to accomplish those things, then a strategic acquirer really fits that bill very nicely. Similar to the family offices, they also tend to favor earnouts, right? Not a lot of companies are sitting there with a management team just waiting to parachute into an acquisition. So they do tend to favor earnouts. The other thing is, if you're not directly in line with the core competency of the acquirer, they're not going to have the right expertise to be able to grow your market segment, right? And a lot of times what they're doing is they're buying a company that's adjacent to their space to try and grow into that space. But for that reason, they're going to need the management team to kind of stick around and help them make that transition. Similar to the family offices, the time frame and process can be highly variable. Some companies have a very formal corporate venture capital arm that they would run this through, and those are usually staffed by people who come from a banking or VC background. So they'll have a very formal, very streamlined process to put you through. Others are opportunistic, right? The CEO or the CTO just finds a company that they're interested in, and they decide to make a bid for it. But once they make that bid, they don't really know what the next steps are. So you can end up spending quite a bit of time just getting through the process with some of the strategics. Most of the time, these companies are going to be public companies. So they do have some flexibility and creativity in how they put these acquisition packages together, but not nearly as much as the family offices. Private equity firms, in the main, they're company flippers, right? What they want to buy is just like home flippers. They want to buy the companies that have good bones, polish them up, and resell them as quickly as possible. They're exceedingly focused on EBITDA. In fact, if you can get a PE to say more than one sentence without slipping the word EBITDA into the conversation, I'll give you a nickel. Earnouts are far less common. Private equity really does have a management team ready and willing to parachute in and take over a company, polish it up, and sell it as quickly as possible. Their valuations, obviously, they're EBITDA focused, right? So their valuations tend to be low. It's not necessarily that PEs are just cheapskates. The difference between a strategic acquirer and a PE is the PE's funding comes from lenders, right? And the number one rule for anybody who's taking on debt is first, you don't lose the principal, right? So they are very conscious of not losing principal when they make one of these investments. More than anything else, more than growth, the PE first wants to assure themselves that they're not going to lose the principal, because that's the money they have to pay back to their investors. So their valuations tend to be very cost conscious. The story matters. I mean, I said story matters less here because it's going to be public, but really the story doesn't matter at all to PEs. They don't really care what you think your company could become in 5 years. You're not going to be there. The only thing they care about is the story they can generate internally before they buy your company. Similar to the other folks, similar to the family offices, they can be extremely creative and flexible in their acquisition models. It really depends on who their lenders are or who their investors are, and how badly they want to get the deal done with a particular company. PEs tend to be very good for companies that are struggling to raise capital or find a strategic acquirer. IPOs. So oftentimes I hear, entrepreneurs talking about the IPO as their exit strategy. And that's all well and good, but keep in mind that an IPO isn't necessarily an exit for the management team. Oftentimes the management team will stay with the company through the IPO. Some of the larger IPOs that we see, sometimes there's a management change that takes place during that transition. But in the main, usually the team that takes the company to the IPO is the same management team post IPO. But it is an exit opportunity for your investors. The other thing is you don't have to be $1 billion company to IPO. As long as you're EBITDA positive, you're big enough to IPO. The caution there is if you're a smaller reporting company, you need to be prepared to support your own stock, meaning you're not going to get the analysts that come in and promote your stock or tell people when to buy, when to sell. You're going to have to do that internally through an investor relations campaign to literally market your stock. And that's what investor relations does for smaller companies. It's becoming significantly more popular these days, especially with some of the online exchanges like Robinhood, for example, is a common place where companies can technically offer their shares up for the public to invest in. So a little bit of background on, or some market data. I wasn't able to pull the same sort of stats that I had on the acquisitions or fundraising, but last year was a terrible year for IPOs. Volumes fell by like 45%. 2023, there's opportunity for some cautious listings, but we're still seeing some headwinds that haven't really cleared on the IPO front. And I'll cover this a little bit later, but the part of this meltdown and the fact that we are seeing so few IPOs generally in the recent history is why the government decided to allow for SPACs. So the general requirements is that you need to have your diligence materials have been audited, plan on a 12-month cycle to actually get before you can actually IPO. It's going to consume the CEO. So if the CEO is very operationally focused, you may need to bring somebody in that can take over operations as a COO or as a president, or maybe the existing CEO transitions to be the president and continue to run the company, and you bring in a CEO that will actually take the company public. But whoever that CEO is, it's going to take a lot of their time to promote the IPO. And the other thing you need to have is an appropriately staffed management team. Don't think that you can take, your existing management team and just ask them to do a little bit more so you can IPO. IPOs are time consuming, so make sure that you're staffed appropriately before you start. The stuff that I was mentioning about the smaller reporting company is if you have a public float, if you're going to sell less than $250 million, then you're going to be deemed a smaller reporting company. That's a good thing because it really lowers the requirements for what you have to disclose and what you have to do to remain listed on the exchange. So you get dramatically reduced reporting requirements. And then if you want to look at other areas, two markets in particular are pretty popular with US tech companies to IPO. One is Australia. The challenge with Australia is you probably don't want to stay listed in Australia too much. It's a great place to initially IPO, but you're probably going to want to uplist from Australia to either the NYSE or the NASDAQ within a few years, because while it's nice to bring in that IPO pop from Australia, the challenge with it is in the governance. The governance for Australian companies is significantly more onerous than it is here in the US. So you'll probably want to move them over within a few years once you've kind of taken advantage of that initial IPO pop. Another area to consider IPOing is Korea. They actually have quite a few exchanges, and they have one that's very focused on smaller reporting companies or small companies here that US companies could take advantage of. SPACs. For those of you who don't know, a SPAC is basically a shell company that is taken public, and it gets listed on the NASDAQ or NYSE. And its sole goal is to go buy a private company that then becomes public post-acquisition. They're kind of controversial. Recently, the SPAC market completely melted down last year. We're seeing a little bit of a renaissance this year. One of the things to keep in mind if you want to sell your company to a SPAC is they have a limited window in which they can actually acquire companies. So what you'll want to do is when you approach a SPAC is understand where they are in that cycle. If they're, at the beginning of the cycle, it's going to be much easier to have a conversation with them. If they're getting close to the end of the cycle, it might be even easier to have a conversation with them because they either need to buy something or they're literally going to get put out of business. So right in the middle is just they're kind of working through their own process. When you launch a SPAC, the sponsors or the management team that launches a SPAC already has an idea of the kind of company they want to buy. Usually they're going to have a list of targets that they want to approach as soon as they IPO. Once they go through that list, if they haven't found the target that actually accepts their bid, then they'll open it up and they'll start taking applications. And that's a great opportunity for some private companies to approach them and see if they're a fit with what that management team wants to do. The tricky thing about SPACs is that the sponsor keeps 20% of the proceeds that they raise from the public markets. So that means that there's 20% less dollars that are going to be available for the acquisition when it actually takes place. Yeah, I think that's it for the presentation. Here's the SPAC market. As you can see, historically, they were very, very low. It was really hard to get SPACs through the regulators. Then in 2016, they changed the legislation because there were so few IPOs taking place in the United States. And they started allowing for SPACs. And we saw this huge run up to 2021. Unfortunately, we also saw quite a bit of abuses taking place within this time frame. So 2022, we saw a huge decline in the number of new SPACs. And then in 2023, we've already had 6 just since the beginning of this year. So it seems like they're on their way back.